Hey everybody, it's Wayne. Let's get you an update. This is going to be week 4 of running the wheel strategy. If this is your first time tuning in, thanks so much. I would encourage you though to go back and watch the earlier videos, starting with my decision to run the wheel strategy on two particular stocks, Celsius and Amazon. Let's go ahead and get you an update on Amazon first. When we last left off, we talked about having to roll the position. It's so important when you are selling either covered calls or cash secured puts that you know how to buy to close early, as well as rolling that position. If we look at line item 3 here, I sold a cash secured put with a strike price of $103. I earned $514 in premium, but soon thereafter, the stock price of Amazon continued to go down, and I did not want to be assigned 100 shares at a strike price of 103. It makes sense. I don't want to own something if I can continue to roll and get down closer to the actual share price value. So I rolled out that position. It did require that I rolled out 2 weeks if I wanted to generate net positive premium. So I bought to close at $718, and then I opened up a new contract for $733. So far in total of running the wheel strategy on Amazon, I've earned $139. And I currently have an open contract with a strike price of $102, and that's going to expire on March 10th. Today's the February 25th, by the way. So I've got 2 weeks to go. But I want to talk about what's really important with cash secured puts, and that's understanding the break-even price. So remember, I've sold a contract. I am obligated to buy 100 shares at a strike price of $102 if Amazon, right, on March 10th, 2023 is at that strike price or below. Well, let's go ahead and take a look at what Amazon looks like right now, and you can see they are yet down again for the week, nearly 2.25%. Current share price is $93.20. Let's go ahead and take a look at the contract information. And you'll see here that I have a put for $102. And the value, if I were to buy to close this contract right now, is $873. That means if I did not, want to be in this contract anymore, I could buy to close that position. But clearly, right, seeing how I received $733, I'd have to pay well over $100 and something to get out of that contract. Again, let's go down and take a look here at some important information, because you might say, well, Wayne, if the share price has gone well below $102, I mean, we look at Amazon and the price right now is $93.20. Why have I not yet been assigned this contract? And it's a great question. It's something that you have to be concerned about. It is quite possible to be assigned early. The person on the other end of my contract does not have to wait until March 10th. He just has to wait until his break-even price is reached. The break-even price is pretty simple. Remember, I received $733 as a premium, which means this person paid $733. So even though the strike price is $102, if we do the math here, right, and we'll go ahead and pull it up, if the strike price is $102, but they paid $7.33 times 100 shares, that means that their break-even price is $94.67, which sort of stands to make sense, right? They're not going to exercise this contract until they can make money on the overall transaction. So yeah, I mean, once Amazon went under 102, they could have exercised that immediately, but it really wouldn't have made sense to them because they paid $733, so they're going to factor that into the overall cost basis of the entire contract. But here's the problem. Amazon has gone below this break-even price. It's gone below $94.67. It's currently $93.20. So I need to be careful, because next week I could easily be assigned this contract early. Now, I can play defensively on this. I could absolutely roll out further in time. I think what I'm going to do, though, is sort of stand my ground. I'm not going to panic. Don't get me wrong, I don't want to be assigned this contract, especially if I'm going to be, nearly $1,000 in unrealized loss. But I go back to the stock that I chose, which is Amazon. I know that Amazon, right, the price of Amazon is going to rebound. So yeah, it would be disappointing to be assigned 100 shares at a strike price of 102. I'm sorry, 102. But I also know that I would be able to sell a series of covered calls, and I also feel confident that the share price of Amazon would go back up. So I'm going to go ahead and wait this out. Now, if we get closer to expiration, which again is going to be March 10th, yeah, if we get closer to March 10th and the share price is still well below my strike price, then yeah, I might make another decision to roll out that position. But for the time being, I'm not going to panic roll. Even though this person could exercise on me early, I'm just going to go ahead and wait it out, keep you posted. Again, I like that I actually did 2 stocks, so I can at least show you some differences in how this one turned out. So let's go ahead and get you an update on Celsius. Okay, getting you an update on Celsius. When we last left off, let's take a look here at line item 6. This was last week's update. On the 16th of February, I sold a covered call. The strike price was $98. Remember, I own 100 shares of Celsius, and I own those 100 shares at $93 a share. For this contract, I had it set to expire on the 24th, and in doing so, I earned a premium of $245. One of the things that I haven't talked about is, why do I only choose to sell covered calls on a weekly basis? Why not sell covered calls 2, 3, even 4 weeks out? Because that could obviously make me more money in premium up front. One of the reasons why I don't do that is I like to only sell 1 week at a time. And this is a perfect example as to how this turned out in my favor. So remember, this contract, line item 6, was set to expire on the 24th. And I wrote this on the 16th, which would have been about 2 Thursdays ago. Well, the 21st, which was 4 days ago, I could see that I was going to be able to buy to close this contract early, right? Thus locking in this premium of $200. So again, I sold a covered call. I made $245. Rather than wait until the 24th, I went ahead and bought to close early. So I locked in $200 by paying $45. I held that contract for a total of 5 days. So I opened on the 16th, closed on the 21st. This is the cool thing about writing weekly calls. If I had written a contract that was 2, 3, 4 weeks out, I would not have been able to do this. And essentially, I wrote 2 contracts for the same week. And I think it earned me more premium. So let's see how this unfolded. So I bought to close this contract early. That was the 21st. The following day, which was the 22nd, I really wasn't able to write a covered call in the same week. And that's because the stock was down. That's another thing that's really important. In a perfect world, if you're going to sell a covered call, you want to sell a covered call when the share price of the underlier is going up, not down. And Celsius was not doing that. So even though I sold on the 21st, the 22nd, I really couldn't do anything. But the following day, which was the 23rd, I was able to sell another covered call. And look at this. The expiration was the same week as this first contract. So essentially, I wrote a covered call, the strike price being $94. Remember, this right here is really indicative of what the share price of Celsius is doing. It's continuing to go up, down, 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 up, down. And that's why you have to understand, Celsius, it's a great stock to earn, juicy premiums on, but it's also kind of scary because it's not like a steady machine where it just continues to trade sideways or slowly up and to the right. This thing is all over the place, and that's indicative by my strike price. But what I will say is that I have never sold a covered call below my strike price, meaning $93 is the lowest I want to go, because if those shares are called away from me, I don't want to take any loss on the initial investment of $9,300. So I sold a covered call for $94. I was able to choose the same week. So I wrote this on Thursday. It was set to expire Friday. And in doing so, I earned a premium of $60. One of the things I always try to do, if I'm going to go ahead and go do this work, right, and you'll see here on this line item 6, right, I had to buy to close this. I spent $45. So if I'm going to buy to close, I at least want to open up another contract to at least make that same amount, if not more. And I was able to do so. I was able to open up essentially the second contract in the same week, $60. Friday, not surprising, Celsius, along with the other stocks out there, it wasn't a good week, but it's a great week for me because I'm selling covered calls that are not going to reach that strike price. So I was able to buy to close early, even though it expired on the 24th, and I bought to close on Friday. I actually did this well before the market officially closed. So I spent $5, and so for last week, I was able to lock in a total premium on Celsius for $255. But remember, because I bought to close early, I did not have to wait to the next week. And essentially, on the same day that I bought to close this contract, I opened up another one. So that was the 24th. I sold a covered call for $100. It is set to expire next Friday, which is March 3rd. And in doing so, I earned an initial premium of $260. Now, this premium is somewhat elevated because we have earnings next week for Celsius. And this is something that I talked about in the very first video. You need to be aware when you are selling cash secured puts and covered calls, you need to be aware of earnings. So let's go ahead and take a look here at Celsius. You can see here currently the share price is $92.20. Again, they were down for the week as well, just over 1%. And if we scroll down here, Celsius is set to release earnings this week on March 1st. Now, I personally think that Celsius is going to beat. I personally think that Celsius is going to do well on earnings, but it doesn't mean that's for sure going to happen. So I kind of had to make a decision as to what I wanted to do. Let's go and take a look at the options chain, and I'll kind of go back over here to the contract first. So this is the contract that I entered. Again, I, on the 24th, sold a covered call for a strike price of $100. So this is this contract. And in doing so, I earned $260. The reason for this week in particular that the premiums are elevated is because, right, it's earnings. So everybody out there, either selling calls or buying calls or selling puts or buying puts, right? Everybody has their belief that the stock is either going to go up or it's going to go down. So they're looking to make money. And we know that typically when earnings are released, the stock is going to react, right? Buyers are going to buy more, or if you're a stockholder, you're going to sell because it didn't do as well as you wanted it to. So let's go ahead and take a look at the options premium. And I'm going to go ahead and go to my perspective. So I sold a call that's set to expire on March 3rd. And if we scroll up here, this -1 indicates that I own a contract. And already the value of my contract has gone down, which is good. That means I've locked in premium. And if I wanted to buy to close right now, it would cost me $203. So I could lock in, what, $57. But I'm not going to do that. But I want to talk about the dilemma that I had, because we go back to what I believe. I believe that Celsius is going to do well this week. So to me, it made no sense to sell a covered call at the strike price of $93. Yeah, I could have earned more premium. I could have earned, you can see here, $515. But if I expect the stock price to go up, why don't I want to also participate in that upside of the share price appreciation? So, I think you could argue, well, Wayne, if you think the stock price is going to go up, why even sell a covered call? Why not let Celsius do what it's going to do, which you think is going to go, up in share price appreciation? Why even sell a covered call and risk those shares being called away? And it's a valid question, and it's one of the things that crossed my mind during this deliberation process. But ultimately, I kind of wanted to do a little bit of both, right? The best of both worlds. And so I sold a covered call for a strike price of $100, which means, going back to my original sort of cost basis of $93 a share, if for some reason Celsius goes to the moon, let's say it goes up to $105 next week. Yeah, I mean, it's going to suck that these shares get called away from me. And, I only, quote unquote, only made $700, but I also earned this premium. And because I have no real ties to this stock, I'm running the wheel strategy, which entails that if these shares get called away, then I'm just going to go right back and rinse and repeat. And I'm going to go ahead and sell another cash secured put. And you can see that's how things started off for me, where I earned $95 for selling a cash secured put for a strike price of 93. And if we look at here at Celsius, right, for the week, I mean, look at Celsius at one point was as high as what, $93, as low as $85. Then we saw it go up again to 91, then it went down to 87. So we're seeing sort of this chaos of the share price continuing to go up, down, up, down. That's why if we look at the volatility, right, let's take a look here at this $100 strike price. The implied volatility on this is going to be rather elevated. It's nearly 100%. And that kind of, again, earnings is tied to that, but also what the history of the share price has done for the last week, month, 6 months, years, all of those factors. So what I did was ultimately make a decision rather than, just saying, all right, let me hold off on selling any covered calls. No, I want to go ahead and generate premium on a weekly basis. That's been my goal. But if the share price does do well, then yeah, I absolutely run the risk of those shares being called away. But I'm not worried about it because, again, my cost basis is $93. That'll, obviously net me a $700, profit on that sale. I earn premium. This is really the most exciting thing right here, $1,140. Now, also last week, I was kind of, do I count the 3rd as being the date in which I began the wheel, or do I count the 26th? I'm going to go ahead and count the 26th, and the reason being is that's technically when I had to, if you will, lock up that $9,300 collateral. So if you look at the 26th, right, today's the 25th when I'm recording this video, that means in 1 month, I made $1,140. That's pretty fantastic, because if I were to just to leave this $300 in the bank in 1 year, there's no way I would have made $1,140, right? If you look at some of the interest yields that are out there, even Robinhood Gold right now is paying 4.15%. Let's go ahead and do the math on that. If I had $9,300 in Robinhood that I left uninvested in my brokerage account, and we go ahead and times this by 0.0415, I would have made $386 for the entire calendar year. So I've made $1,140 for the entire year. Now that's on 1 month. So now we have kind of a month that we could say, all right, that's a pretty good estimate. Now, I personally did not expect to make $1,140. My goal was to make anywhere from $100 to $200 a week. So I definitely exceeded that goal. So let's go ahead, and even if I made, we won't say $1,100, let's just say $800. Let's say I was able to continue to sell covered calls, generate this premium, and I did this every month for the next 11 more months. So if we go ahead and times, $800, and we'll go ahead and just say times 12 months, that's $9,600. If I can continue this momentum of selling covered calls, that $9,600 in premium is more than what I initially paid for my 100 shares of Celsius. Do I think I can generate $800 every month for the remainder of the year? I don't know. I mean, I'm somewhat optimistic. I wish that Celsius had a little bit better volume than what it does. Implied volatility has been very nice. So we'll see. I also think that earnings this week is going to play a big role. So I will be watching very closely. And here's the deal. If I'm wrong, right? Let's say Celsius does not do good in earnings and the share price drops down. Well, then clearly the strike price of $100 is not going to be reached. Chances are I'm going to keep a fairly large percentage of my premium, and I hope that the share price does not dip below my cost basis. But guess what? We know it has. Even this week at one point, right? I mean, imagine if I had just purchased 100 shares at $93 each. And you look at this, you're like, oh man, on the 22nd, right? I mean, Celsius dipped way below my cost basis, nearly $8. So that's a nice thing also about selling covered calls. Even if you have a current unrealized loss, selling covered calls is a great way to continue to generate that steady cash flow, even if you are bag holding, so to speak. So I'm excited. Again, I'm going to go ahead and throw out my prediction. I think that Celsius is going to do good in earnings, but if it didn't, then I would just continue to sell covered calls. If it turns out that my shares get called away, then I'm going to go ahead and start over again and maybe even sell a cash secured put against Celsius, and maybe I'll be able to sell a cash secured put and get back into owning 100 shares closer to, $85 a share price, or a share $86. That would be really nice if I'm able to really capitalize when Celsius is at that low. And then now, I own 100 shares at even less than what I'm currently at. So I hope you guys are enjoying these updates. Here you have it, right? Celsius and Amazon. I would not have predicted that Celsius would have been more profitable for me 1 month into running the wheel strategy. I'm also going to be announcing another wheel strategy, because here's the deal. I have made $1,140 selling covered calls or doing the wheel strategy on Celsius. If we go to Amazon, I've made $139. That's a total of $1,279. Great question that you might ask, Wayne, what are you going to do with that $1,279? And I really think that I'm going to find a stock that is obviously, in the price range of maybe $15 to $20 a share price. And why not start continuing to run the wheel strategy and expand out to a third stock? So stay tuned on that. Admittedly, and if there's been a few comments asking like, Wayne, why can't you run the wheel strategy on a stock that's well below, right, that $100 a share price? It's just tough. It's tough to find that perfect share. I do have some requirements. And the first one is I have to feel comfortable owning 100 shares of that stock. And, don't get me wrong, there's great stocks out there. But running the wheel strategy and owning a great stock, those goals don't sometimes align. But either way, I am looking and I am practicing, and I've seen a few of your comments. I know some of you are running the wheel strategy on stocks that meet that price criteria. So stay tuned. You might just get a good update along those lines. We'll talk to you soon. Thanks again.